Welcome to The Marcus Warren Show, powered by 960 Digital and the Wealth Empowerment Network. Now, here is your host, Marcus Warren.
All right, here we go on a Sunday. It's The Marcus Warren Show, the #1 retirement and tax planning show in the region. I am your host, financial advisor, tax enrolled agent, and author of the Retirement and Tax Playbooks, Marcus Warren. And I hope everyone is doing well on this Sunday. And to my left, I am joined by our resident tax professional, Dee. How you doing, Dee?
Hello, and happy Sunday.
And remember that if you miss any parts of the show and you want to catch up on anything that you missed, all you have to do is subscribe to the Marcus Warren Show podcast via Apple Podcasts, Spotify, or wherever you get your podcast. Also, throughout the show, we will be offering a copy of my book, The Retirement Playbook, a free copy, by the way. All you have to do is go to warrenwealth.net. You go to warrenwealth.net, you put in your information, and you will receive a free copy of my book, The Retirement Playbook, delivered free of charge to your front door. That book is a great resource that talks about all the threats all the risk that threatens your nest egg. We're talking about tax rate risk, interest rate risk, and of course, stock market risk. You have to protect your hard-earned money. Once again, all you have to do is go to warrenwealth.net and put in that information. So there are a lot of topics, a lot of things going on in the news today. But let's talk about some of the things we're not going to talk about. We're not going to talk about the death of the first woman on the Supreme Court, Sandra Day O'Connor, RIP. We're also not going to talk about the end of the truce between Israel and Palestine. Definitely not going to talk about that. But we're definitely not going to talk about the useless DeSantis and Newsom debate. We're not going to talk about that because we talk about retirement, finances, and money here. And why do we talk about money, people? Because money matters.
Here comes the money.
Here we go. Money talk.
Here comes the money. Money, money, money.
Dollar, dollar, dollar.
All right. So let's do this. Let's talk taxes and tax planning, specifically why I believe taxes are going to be going up. So for the past 46 years or so, financial professionals have been telling people that your taxes will go down in retirement. And for 46 years, this has basically been true for most Americans. And because of that truth, we've created an entire universe of these tax-deferred retirement savings plans. I'm talking IRAs, 401ks, 403bs, simple IRAs, and we've been taught to defer. And tax deferral has seemed like a brilliant concept at the time, right? Pay no tax now, let your money grow, then pay tax later when you decide to take it out, when your taxes could be lower. And since 1978, way before your time, D, Americans, we've been deferring our income into these 401k plans, right? And boy, did those tax-deferred investments grow and grow and grow. Americans' retirement plan assets, they basically exploded. There is now over $30 trillion, that's with the T, in these retirement plans. But things have changed, people. But where are we today? Well, the 2017 Tax Cuts and Jobs Act, it changed a lot of things. Number one, first, corporate tax rates, they were cut a lot. That flat tax rate went from 35% down to 21%. And people, those changes are written to be permanent. Now, let's talk individual tax rates. Individual tax rates were also cut. All tax brackets went slightly lower. But these low tax rates, they expire at the end of 2025. Now, at the same time, the U.S. budget deficit has doubled in the past 3 years. Our federal debt is now 75% of GDP. or gross domestic product. Now, it is projected to be 144% of GDP by 2049, and that's higher than any time in the U.S.'s history. It's even higher than post-World War II when it was 106% of GDP. Now, if these tax cuts are extended, which they may or may not be, we can discuss that on a later show, that debt would go up to 219% of GDP. Now, what does all this mean? GDP, 219%, all these percentages and on this this terminology. Well, imagine this. Imagine if you had annual income, or your household had annual income of $100,000, but you owed Visa and MasterCard $219,000, right? That's what the U.S. is basically facing now. And that was all before the $2 trillion coronavirus aid package. So let's put this all together. What does this all actually mean? It means that the government needs money, people, and retirees, pre-retirees, you all that listen, are sitting on $30 trillion in retirement savings that has never been taxed. And so for the first time in 46 years, it is very possible that your taxes in retirement will go up. And I'm sure a lot of you agree. And if you do, raise your hand out there. Now put it back down. Keep both hands on the wheel if you're driving. Now, if taxes don't go up, which I think they will, there's always these indirect tax increases, right? Maybe increased fees on other programs like Medicare and Medicaid, higher taxes on Social Security, lower thresholds for taxation, perhaps. Maybe they'll just reduce benefits, or maybe they'll just change inheritance rules. No, they already did. They already did that, right? With the Secure Act of 2020. They basically changed how fast your beneficiaries have to spend down the inheritance so they can pay taxes on it quicker. That is why we do what we do. And you all need to be aware of these things, that your taxes in retirement, they will go up, and you need to plan ahead. So think about this. So in 1980, the highest tax bracket was 70%. Today in 2023, the highest tax bracket is 37%. In 2024, the highest tax bracket is going to be 37%. And in 2025, the highest tax bracket is going to be 37%. So it's a whole lot lower today than it was back then. Now, this 37%, our highest marginal tax bracket, is on incomes of $600,000 or more. Now, that doesn't affect me, and it probably doesn't affect a lot of you out there. But you also know in 1980, there was also a 37% tax bracket. And that was on incomes of close to about $30,000. And you might say that that's not much money, Marcus. But remember, I'm talking about 1980. A married couple, two teachers in 1980 making $15,000 each, easily had a combined income of about $30,000. So low middle income America was paying 37%. So how can we make that number relative for today? So let's inflate that number by the historical inflation rate of about a little over 3%. Now, if you inflate that number to today's dollars, about 43 years, that's a little over $100,000, $101,167 to be exact. So basically, somebody making the equivalent of $100,000 in today's dollars back then, you would be in the 37% tax bracket, right? Now, what if you make a little over $101,000 today? Well, minus the standard deduction, you are in the 12% tax bracket. So if you've been to one of my workshops, if you've read one of my books, if you've heard me on the radio, you know that I've been saying this for the last 5 years, that we are in the lowest tax rate environment that we've been in our lifetimes, the very lowest. And it gives you some opportunities and it gives you some options in regards to retirement planning. So let's do this. Let's go back to 2017. So the Tax Cuts and Jobs Act, it reduced taxes beginning in 2018. Unfortunately, these cuts, they sunset or they expire at the end of 2025. And that basically means that in 2026, they are going to go back they are going to go back to the rates that they were in 2017. So in 2026, if you made that same $101,000 that you're making today, after the standard deduction and exemptions, you're going to now be in the 25% tax bracket. Double, just like that. So you fall asleep December 31st, 2025, making $101,000 in the 12% tax bracket. You wake up January 1st, 2026, and bam, making the same $101,000. You're in the 25% bracket. But I believe it could go higher. Why is that? Because of our rising debts, deficits, and our unfunded liabilities such as Social Security and Medicare. Oh, and the national debt is over $33 trillion. And one of the only ways to deal with that is by raising taxes. But right now, at this moment, they are the lowest that they've been in about 80 years. And like I said, this gives you some opportunities, and it also gives you some options in regards to retirement planning. But time is ticking. Only 3 more tax seasons left before these rates go up. So who knows? Think about it. Anyway, so a lot to talk about on today's show. Coming up next, we're going to dive into some tax planning tips that you need to take before the end of the year. Like I said, time is ticking. You are listening to The Marcus Warren Show.